Yes, so before we proceed with the question number 13, okay, so we will have some just recap and some updates on the theory. I have updated with certain more theories. Yes, again we will try to understand what is this non-current and current. Now we are much familiar. Now we need to look into something called an operating cycle, which is the time from the time it takes you purchase the raw material till you get the cash from the customer. Now what that logic works, I have updated with more examples. Now current assets, when do you say? When it is either expected to realize within your normal operating cycle, irrespective of how long it is. It can be 28 months also. Something you have to receive after 25th month, means to almost like 2 years down the line, but still it is current. Or you are holding it for trading, or something which you are going to receive within 12 months, or asset is the cash. Now an entity shall classify all other as non-current. Similarly, liability, something which falls within your operating cycle, even though it is 2 years, it is your current liability, or you hold it for trading, or 12 months, or you should have some right, unconditional right to defer the payment at least next 12 months. Then we can call it non-current. Okay, if you do not have the right, then it is current. Okay, this is very important from understanding one carve out on breach of the long-term loan. Now, what is an operating cycle that we discussed? It is a time between acquisition of assets and realization of cash. And if this is not clear, then it is assumed to be 12 months. Now, what if my operating cycle exceeds 12 months, like I was giving example, 28 months, 32 months, in real estate company it is going to happen. In such case, you have to give certain additional disclosure. What is that disclosure? Just how much amount is receivable within 12 months and after. Suppose some customer is supposed to give you after 12 months only, say 25th month. You classify it as a current, but should not people know whether current means what? People generally assume it is less than 12 months, but somebody is paying in 24 months from now. So you have to give one additional disclosure. This is clear? Now I have prepared one chart for you to understand. Now credit term as on 31st March, like for how many months if that person is going to take to make the payment as on 31st March. From 31st March, in the case 1, it takes 10 months. Now what is your operating cycle? Say for example 8 months. What is normal period? 12 months. This is normal, assumed to be 12 months, because any or condition, no? Is it a current or non-current? See, if this 12-month condition was not there, this would have become one non-current. If I go back to this example, if this condition was not there, then I would have told I am not holding it for trading, it is not a cash, but I am going to realize after my operating cycle. Then I would have classified it as a non-current, even though it is something is receivable in 10 months. But what I will do, I will classify it as a current. Why? Because it is less than 12. Are you clear about this? Anyone? That's what, no. If this condition was not there, then none of the condition would have satisfied. If any one of the condition is satisfied, it is called current asset. Then it would have been non-current. Why? Because see, first of all, your debtor is not a cash, debtor is not your held for trading, and it is beyond your operating cycle. That's why debtors and inventory by default always will fall within, creditors will always fall within operating cycle, because they will go into the calculations, no. But it is an average, non-current. And this is operating cycle, what we do, it is an average. So there can be one particular contract who gives me payment after certain time, but followed, no, then I need to apply. What about the second case? Like my credit term for that one contract is 10 months, my operating cycle is 15 months. Current, because both the conditions are fulfilled here. Here previously this condition didn't fulfill. I'll take the case number 3. 15 months is the credit what I have offered, 8 months is my operating cycle, 12 months is my normal thing given. Both the condition didn't satisfy. It is not a cash. It is not even held for trading. So it is not current. Do I need any disclosure? Operating cycle has crossed? No, because my operating cycle is less than 12 months. That I have to disclose. Otherwise, how someone come to know? And the last one, I have got a 15-month credit. Operating cycle is also 15 months, but my period has crossed 12 months. Still it is current. Will I give additional disclosure? Yes, because it has, my operating cycle has crossed 15 months. And why I am saying it current? Because even though it is crossing 12 months, it is less than or equal to my operating cycle. If any one condition should fulfill, no. Any one condition should fulfill. In this condition is fulfilled. Perfect. Very clear, dot clear. Disclosure means, since you are operating CSF, this person is paying when? After 12 months, but less than, but in the balance sheet you will show it as a current. Generally what somebody will think, current means less than 12 months. This is from our childhood, anybody would have thought. Now you have to give disclosure, look, it is a current, but the money will be received after 12 months. Then why did you classify it as a current? Because it is less than within operating cycle. Very clear, no? Yeah, because with this, if you look into the question, things will be much more clear rather than simply discussing. What about the capital advance? What if I had given one capital advance to one creditor? See, capital advances are given generally for procurement of capital assets. So typically company do not expect to realize them in cash. If I go back to the, see, simple, what is the definition of a non-current? None of the following conditions should be fulfilled. When you give capital assets, is it within operating cycle? May not be, because it generally takes time. Holds for the purpose of trading, it is not cash, it is not expected to realize within 12 months or whatever. Point is, when you pay any capital asset, it is always a non-current asset. Why? Because that advance is eventually getting turned into one PP. You never realize it. If it was getting turned into inventory, inventory would have sold, inventory would have got the cash. That's why it's part of your operating cycle. So here for capital advances, that operating cycle and all, you don't apply that. Are you clear? Because they are going to get converted into non-current assets. Under Schedule 3 of capital advances are not to be classified under CWIP. That's why we show them separately as a non-current assets. You remember in later, you are going to find problems in analysis of the financial statement where you have to present. There is 150,000 something like capital advances given. You cannot club it, and some mistake they said mixed with some CWIP. No, you have to show it separately. What about the demand loan is given by the parent to the subsidiary? Like for example, MN, OMN, there's one question. See, a parent may provide loan to the subsidiary with, generally without any terms, correct, no? When, see, if you have to take a loan from the bank, you need to have so much documentation. From parents, no documentation, no terms, with understanding. Now, it can be on demand loans, but intention may be never to settle it. So now how to account in the books of the parent? It all goes with, what is your expectation? Are you going to realize it, or are you going to, do you expect that subsidiary to repay you? If answer is yes, and that if you think it is less than 12 months, then it is current asset. But if you think no, my intention is let them keep it forever, and whenever they have got money, they let them pay me. In that case, it is not current asset. Which one? But it is an on demand, no? There is in financial 109, there is one question. Okay, when there is an on demand loan, that means, now from whose perspective we are looking here? Parent. For parent, it is an financial asset or equity? Financial asset is an investment only, no? You will show under investment head only. Equity comes now to that subsidiary now, whether it is an equity contribution or liability. So, parent, see, understand here the catch. The parent could have classified into current and non-current. Why? Because it all goes with the application of the third condition. Are you expecting it to realize within 12 months or no? That is the question. It's part of the investment, but non-current investment or current investment? In investment also, first thing we start with non-current assets, financial assets. Current assets, financial assets. Is it part of non-current assets or current assets? No, that depends upon what do you think, when you are going to get the money. They will pay me, that's what, right? When parent give you, understanding is when parent is going to demand, they will pay. Yeah, when I demand or when I think, see, it is the relationship between parent and a subsidiary. So parent is not harsh enough on a subsidiary, right now you give me. Followed, no? So there is one understanding, okay, by the end of the year I am going to get it back, or you keep it, okay, we will see later. If I then I will shift it from non-current to current. Not initially. Initially, you pass one accounting entry, investment account debit to bank. See, the problem with the current non-current comes only on 31st March. Now, on 31st, forget about initial, no. On 31st March, from now onwards, is it outstanding? If it was not outstanding, then there is no question only. If it is outstanding, when you are planning to get it back within next 12 months, yes or no? Answer is yes, current. No, non-current. Here, that means there are two possibilities. Why? Because of the third condition. Now, but when it goes to the subsidiary books, now on-demand loan is a financial liability. There is one problem, KK limited, something we have done. So, you don't have any option to classify current or non-current. Why? Because the third condition says what? Unconditional right. You should have unconditional right to defer. See, both the conditions are different here. Huh? This fourth condition is you should not have any unconditional right to defer for next 12 months. Do you have this? No. But here, question is whether you expect for settlement. So, I will apply third condition here and classify as a current. But you can apply none of the condition. So, for a subsidiary, on-demand loan is always a current liability. But for the same loan, for the parent, may be a current or may be non-current. Depends upon when they are expected to pay. Okay, clear? Now we will talk about the breach of terms and condition. It's the same slide, same content which we are going to discuss in Ind AS 10. We will discuss it again. Or if Ind AS 10 is not done, you will come across the same thing there also in Ind AS 10. When there is a breach of a material provision of a long-term loan on or before the end of the reporting period, with the effect that liability is going to become on demand, and agreement is entered for approval of the before the approval of the financial statement, not to demand the payment for at least for next 12 months, or to rectify the breach and give the time for next 12 months, then it shall be considered as an adjusting event. From non-current, again it is going to go back shift into, from current it is going to become a non-current. For example, if you have taken a 10-year loan on 1st of January, there were certain conditions to be fulfilled. You didn't fulfill that by 31st March. So, on 31st March, it is a demand loan. By 31st March, the condition was broken. So, it has become current liability. It is not actually to see, it is a non-adjusting event. Because there is no uncertainty. It is for sure short of the current. But now, when you have entered into an agreement on 15th April to waive the breach, say forget it, or to give some extra time, then this becomes an adjusting event and it will be classified again into non-current event. Minimum 12 months, so that I can apply this right. I have got an unconditional right, so that I will treat it as a current. That's why I say minimum 12 months. That's why you have to be very careful, because if the question is twisted in the examination and they say, oh, they agreed, these lenders agreed, and they agreed to give 10 month time to rectify the breach or something like that, no? Then we will not demand for next 10 months. No, then still it is current only, because you don't have an unconditional right to defer for next 12 months. Now, this breach is happened before 31st March, yes, it is an adjusting event. There is a carve out in Ind AS IAS 1 that they are still considered as a non-adjusting event and they are classified as a current liability. Thus, when the breach on the reporting date, it should be as on reporting date breach should happen. The loan is by default classified into current. In IFRS, it is still current even though you have got a grace. But in Ind AS, it is non-current if agreement is reached before approval. So, I will give an example so that you can appreciate this. You have taken a loan of 5 years. The last date for some compliance was 25th of April 2024. This amount you are supposed to pay 5 years from now. And there was some condition. And that condition, if it is not fulfilled, then it becomes immediately paid. Now, what was the last date to fulfill the condition? 25th of April. Now, as on 31st of March, is it current or non-current? Question is clear? When the loan is repayable? Loan is repayable 5 years from now. So, as on 31st March, when this loan is supposed to be paid? 5 years from now. Now, there was one condition in the loan. If that condition was not fulfilled, then this is immediately payable. And what was the last date to fulfill that condition? 25th of April. Now, tell me on 31st March, is it current or non-current? It's always non-current. No? By default, it is non-current. What you can do? Because my compliance date is after 31st March. No. As on balance sheet date, was there any breach? No. So, you cannot force me now. I could have done it on 10th of April. Okay, my problem, this carve out doesn't come here. That question doesn't apply here only. Carve out question comes only if you have breached before 31st March. Now, if you have breached before 31st March and okay, you didn't breach only, or breach happened 25th, but before extension you got before the breach only. You are about to breach now on 25th of March. So, before breach only you went and took extension time. Possible, no? Somebody comes to know before only I am not going to default. So, first only you go and surrender. Then non-current, because already you have taken that approval. That never should. Less than 12 months, no, because point is you should have got that right at least next 12 months. They should not demand from you. Then it is current. Then whether you do it before breach or after breach, but did the breach happen? Then how can you say on the 31st March breach should have happened? 10 months for, then that means it went up to here. That condition, compliance condition itself went to the 10 months. No. Understand, there are two things. One, you breach. Another is you get an extension to compliance. Or if you breach, you get an extension to not to demand. There are two things. First of all, the breach condition itself you get an extension. Just 6 days you get an extension. Forget 10 months. On 25th of March, you get the breach extension just by 7 days. Just 7 days. Then, even though you breach on 1st April, on 31st March it was non-current. Because you didn't breach any condition on 31st March. Understood? Now, breach has happened. Then needs an assessment. Breach didn't happen, then that means normal, Baba. Who can demand? Or you have extensions and all before also, it's a non-current. Now, breach happened as on the reporting date, then either you should have got 12-month grace period to rectify the breach, or 12 months grace period not to demand the payment. Then you can reclassify it as a non-current liability. I hope now you are much clear. Now, why there is a reason? Because Indian banking system generally loan agreement contains so many conditions, and banker customer relation is generally, these loans are not called on demand. Even though they threaten, I will call on demand, generally they don't do it. That's why, and many cases it is happening. That's why they say Look, in Indian scenario, let us do it like this, because this is what reflects the substance in Indian scenario. Clear? Yes, now we will see some of the theoretical questions so that you become very much clear, your understanding becomes clear. Okay, so there were two questions which I clubbed with the our main, there are two questions here, which is on the bank loan, refinancing and all. We will discuss it together. Now, question number 13, very nice question. XYZ Limited is into construction of turnkey project. Yes, obviously you should expect high operating cycle, and their operating cycle is 18 months, 1.5 years. Now, company has got certain trade receivable and payable within 12 months from the reporting date. Is there any confusion? No. In addition to above, there are certain items. So, in addition, okay, this is a 4-mark question which took place during the year 11-12. So, this is what you need to check. The company has some trade receivable which are due after 15 months from the date of the balance sheet. So, the company expects that the payment will be received within the operating cycle. It is after 15 months, but within operating cycle. Now, they want to present the trade receivable as current despite they are receivable after 15 months. Are you okay? Yes, you have to say that it is within the operating cycle, correct? The company has got payables which are due for payment after 14 months from the date. However, these payables will fall due within a period of the operating cycle only. Company does not expect that it will be able to pay this payable within the operating cycle. Say previous one, it was within operating cycle, but company was expecting to receive it. But this time it is within the operating cycle after 12 months, but they think that they will not be able to pay it. Because of the nature generally projects will get delayed and my payments will be delayed. So, what is your opinion here? And what they want to do? They want to present it as a non-current despite that within the 12 months. Is it okay? Yes, what is your opinion? Is it a current or non-current? So, what you okay with the management? Not okay with the management. Yes, you should not be okay, because see, this is within operating cycle. No, what you expect, based on that you cannot do it, because here it goes with your unconditional right. Do you have an unconditional right? No, you have to pay it within 12 months only, or say 14 months, or whatever it is within your operating cycle. So, this will become your current. The company was awarded a contract of 100 crore, and as per the terms, the company made a security deposit of 5% for 5 crores on 31st March 2012, exactly on the last day they made the payment. The contract is expected to be complete within 18 months time, and it will be refunded after 6 months from the completion of the contract. So, totally when I am going to get this back? 18 plus 6. Now, can the security deposit be presented as current? No. It should have been received within your operating cycle. The company also given a certain contract to third parties and received the security. Oh, this time we received a security deposit. They are payable on completion of the contract, but if the contract is cancelled before the cancellation of 18 months, then it becomes payable immediately. However, the company does not expect the cancellation within 12 months. Can you classify them as current, non-current, or this is a current? Yes, Aditya, what is your opinion? It's a non-demand, like, and cancellation is not within your control. Customer may cancel in time and they may ask you. Followed, no? And you know what they have done? They replaced data. All these questions, what they have done is, first they asked this part in the study material and for answer following question 1, 2, 3, 4. All stories clubbed at the top, questions clubbed at the bottom. Now see, I reshuffled it for your understanding why this question came in the examination with this format only. See, when you see that oddness, no, this format it came in the exam. So that's why for me also it is irritating. I have to scroll down, up and down, and it doesn't remain in your mind. Now it is very easy, no, with the story only you read the question. In the exam they give you, but you see the study material, how much difficulty they create to make you understand. Yeah, we generally skip this, no. Okay. So now first part, yes, what you said is correct. It is a trade receivable is a current because within 12 months, but you have to give that additional disclosure since it is after the operating cycle is after 12 months. Now second case, no, you cannot disclose it as a non-current because it is payable within 12 months. It is within the operating cycle only. Okay, so you cannot disclose it as a non-current. It is still current only, trade payable and trade receivables, but you have to give that additional disclosure. Security deposit cannot be current because it is after the operating cycle of 18 months plus 6 months. And no, security deposit cannot be presented as a non-current because you don't have any unconditional right. If the contract gets cancelled, you may have to pay it before this cancellation only. It's not within your control. Now, this question came in examination. Yes, students, it is a 4-mark question. I want you to please pause the video and write this, solve this question. Then we'll continue. Read this question yourself and we'll continue them. Okay, students, so we'll compare the answers. Now, see, when it comes to that example of MN Limited and ON Limited, we have seen very clearly when something is receivable to you, you have to expect so as to classify current, non-current. Why? Because that unconditional right of defer of that condition is not there for current. But when it is payable, you have to test one condition: do you have unconditional right of deferring? So expectation is not, because people will not leave you. Okay, so was it same question? Different question? Nice question in the exam, 4-mark. And see how much fast you should be and how much clear you should be. In one reading only you should make out. Again and again you sit and read this, no, then this is not worth only writing 4 marks. So in the first case, they twisted here. They brought one element of 70-30 deposit. Now what is your opinion? The rest everything story same. I don't want to read this. Correct? 70 is a current, 30 is non-current. Okay, so let us see here. No, 70 should be immediately classified as a current and 30 will be non-current. So management decision is not correct. Please remember to write that. Question is not what is current, what is not current. Otherwise you may have to lose half mark for not writing it. Look into the question, I am telling you again and again. Now the company trade receivable, this is the repetition. This is conceptual. This is procedural. So what it is the management decision correct? Yes or no? It's correct, yes, no. Because it is within 12 months. Now, twist here is not procedural, I think, it is conceptual. It is a trade receivable part, right? And management want to classify them as current. Let me go to our example here. First part is the trade receivable. Trade receivable is due within, and okay, here also it's a procedural. It's a procedural. Same ditto, repetition has come. That means some trade receivable is there after 12 months but less than operating cycle. The third, they are receiving a security deposit repayable on completion. This is also procedural. Followed? That means see what is the element, 50% procedural, 50% conceptual. And the last one is a conceptual, which was never came. Somewhere in theory you would have read. So this is capital advance is always a non-current. So first question here is this payable on completion. This becomes a current. So management current intention is not current. So they have to classify it as a current liability. And the last one, there is one challenge. There are 2 types of security deposits. That also you need to write. Yes, they are correct for that 0.5 crore. But for capital advances, no, they are not correct. Capital advance is a non-current liability and for your other thing may be classified as a current, non-current assets. Are you clear? Nice question. So you understood how they will ask. So they are considerate to the extent of 50%. 50% is your choice. Okay, next question. See, now we are coming into that loan breach of condition. This question has come in your RTP. An entity has taken a loan from a bank that will be repaid within a period of 9 months from the end of the reporting period. What it is? It is current. No confusion there. On 31st March, you have to get. Now, prior to the end of the reporting period only. That means it's not a question of subsequent event. See, adjustment and all, the breach happens, then you go there. That is when subsequently, right? The entity and the bank enter into an agreement where the outstanding loan is unconditionally rolled over the new facility. So, how should the loan be classified in the balance sheet date? That means new facility is going to expire in next 5 years. So, this happened before your end of the reporting period. It is non-current. Clear, no? Now, will the answer be different if you have agreed after the end of the reporting period? Yes, now that breach, whatever, things is going to come. But the problem is, this question is very silent about it. That's what I want to tell you, that in the case 2, it's very silent about the breach and carve-out provision. So, in the solution, what they have assumed, that the assessment provides that you do not have any unconditional right at least to 12 months. That means you have entered into thing, but that 12-month condition is not there. So, whatever it is. So, your answer will be different, yes. So, they have not considered for this particular question that breach question has not been, provisions have not been applied. Now, there is no breach as such, that is what, we cannot apply that condition. So, we can play on a plain reading, we can say no, answer will be different. In the second case, if the arrangement is agreed upon after the end of the period, classification will be different. The assessment is required to be made for the existing term loan, and if you don't have any unconditional right to defer, it is 12 months, hence it will be correct. Because as on 31st March, you didn't have any right, you entered afterwards. Okay, again, that this provision is very silent. This is the part you asked now, last time. But if you look at the question is very silent. They said assessment is required to be made on the terms of the existing loan facility. Okay, so this question is not a question on that breach. Question is very silent. So this is, if it comes for the exam, this is what you need to write. Now, will the answer to A be different if existing loan facility from a new bank and new facility from another bank? Yes, obviously no, because this becomes current only and the new becomes non-current. It is not the same bank, right? And will the answer be different if the new facility is not yet tied up with the existing bank, but you have got a potential to refinance? If you expect that they may do it, no, it becomes current only. Followed, no? So, in the first case, they are not due for payment as on the reporting day, and bank have agreed to roll over before this thing only, so it is classified as a non-current, because you got right now, next to defer. If the second arrangement rollover is agreed after the end of the reporting period, classification would have been different. It would have been treated as a current, because entity do not have got an unconditional right to defer. Question is not much clear, that settlement liability for at least 12 months after the reporting period. If you look here, yeah, they have got a right to for next 5 years. But the question that breach, that carve out is not applied. This is what you need to, this one like confusion. Okay, that we can say there is only when that exception is applicable, only when there is a breach. Here there is no breach, here it is a normal thing. You took one new loan afterwards, so it is a non-adjusting event. It is only for the breach, it becomes an adjusting event. We can interpret it like that also. Then it will be much more clear if we interpret that way. If it is a breach, yes, carve out will apply. If it is the normal day-to-day course, like you negotiate, you roll over and all, it is not a carve out. Now, third one, you cannot treat it as a refinancing, because it may coincide, but you have taken it from some other bank. No, So as on date, it is current only. And answer will be different because you should classify it as a current because you expect, that means it is not at your discretion, no, it is not your right to get that refinancing. So it will be classified as a current only if you are expecting. Now this question also came for exam. See, from Ind AS 1 also how many questions have come? Same question they asked you before the end of the reporting period only it happened. How should the loan be classified as on the balance sheet date? This is the procedural question. Will the answer be different if the new agreement is entered after this? Will the answer be different in new facilities not yet tied up with the bank? See, it is a ditto procedural question for 5 months in May 23 exam. But this is mixed with that all other breach condition, no? So some confusion comes there. Should we apply that breach carve out? So here same thing, loan is due for payment, so it is, you do not have unconditional right. So you got an unconditional right, so it is non-current. Second is assessment is required, so it will be current. It's simple rollover, not a breach. And the third condition would be, it will be classified as a current because in anticipation of this, you don't have a right to defer it for 12 months. Okay, one more examination question which is there in your test your knowledge, MTP. This is a proper breach condition. See, consecutively we are, and this question also has come ditto as it is in the exam, in the study material. Now in December 2011, entity entered into an agreement with the bank and the loan is repayable in 3 equal annual installments starting from 2015. So we have got time. First installment only we have to pay in 4 years down the line. Now one of the loan condition is that it should be equal amount should be contributed by the promoters also by 31st March 2012. That means within next 3 months, promoters should contribute. Now if they don't do it, it will become payable on demand. This is a pure carve out question. Previous was not a carve out question. Now as on 24th March, the entity had not been able to get the promoter's contribution. If this condition was there on 24th of April, doesn't matter because as on 31st March, no breach also happened, nothing, no confusion. But if this happened on 24th March, you are not able to get the promoter's contribution. Now question came, did you go back to the bank? Now on 25th of March, the very next day, the entity approached the bank and obtained a grace period up to 30th June to get the promoter's contribution. Are you clear? Now, on 31st March, is it current or non-current? Non-current because breach never happened, or even though breach happened, you got an extension to, that means unless you breach again on 30th June, bank cannot demand now. Understood? They may ask you different way also. The bank now cannot demand immediate repayment since because of the grace period. It's not that they said next 12 months I will not demand. No. I will not give you 1 year period. I will say that okay, what condition you have breached, no, that I will give you grace. That means again as on 31st March, you cannot force me now because you only gave me second contract. I will show the second contract now. Now you talk to me only on 30th June again if you want this loan back. The reporting period is 31st March. As on 31st March, how should you classify the loan, current or non-current? Now non-current no, because that's what you need to apply. Which one? Yeah, but you what extension you got? Grace period not to demand immediate payment during the grace period. That means what if I on 10th of April I will fulfill? Okay, yeah. 1 minute. There is one catch here. As on 31st March 2012, how will the loan be? Entity would classify the loan. Assume that in anticipation that it may not be able to get the promoter's contribution. Yes, here we need to understand. By the due date, in February 2012 only the entity approached the bank and got the compliance date extended up to 30th June for getting promoters contribution. Okay, in the second case breach didn't happen. This way we have to interpret it. In the first case breach happened, but the moment breach happened, 12-month extension for you have to get that. In the second case, compliance date got extended to 30th June before its breach happened. In this case, will the loan be classified on 31st March different from A above? Which one? Again, there is no reclassification. Now, let us see in the illustration what they have told. In December 2011, entity entered into an agreement. One of the conditions that equal amount should be contributed 24th March. On 24th March, entity not being able to get the promoter's contribution. On 25th March, they approached the bank to get this. The bank cannot demand payment. On 31st, how do you classify the loan? Assuming anticipation by the due date. In February only, they approached the bank compliance date to 30th June for getting promotership. Okay, it's the same question. I don't know why I have given it as a different, or maybe in the exam they must have asked this. Yes, the entity classifies the liability as a non-current if the lender agreed to provide a grace period of at least 12 months within which they can rectify the breach, and during which the lender cannot demand the immediate payment. Okay, even that grace period to rectify the breach also should be 12 months. Yeah, it's not just your grace period is extended. In the present case, the grace period what you have been given is only 3 months, which is less than 12 months, hence the loan will be classified as a current. Yes, probably I have to change that chart. In chart I had given I have given 12 months grace period. No, let me see. I have told here, no, it should be 12-month grace to rectify, or it should be 12 months and during this not to demand immediate payment. 7 days I said, okay, maybe while explaining I said even though it is 7 days, 30th April, 1st April I said, no, that's mistake there. So it is a 12-month grace period to rectify, 12 months not to demand the payment. See, our Q&As will give us a better understanding over these concepts. Okay, no? Yes, in the second case, Ind AS 1 deals with the classification of liability in current or non-current on the breach of the condition and does not deal with the expectation of the breach. So, carve-out becomes applicable once the breach starts. In anticipation of the breach, you cannot do this. So, in this case, the actual breach has taken place shall be assessed only on 30th June now, not on 31st March, because you got that extension. So, in the absence of the actual breach, the loan will be classified as a non. No, they see that's what. No, in India maybe that is the scenario. That's why they have given this carve out. No? Because this otherwise this question doesn't come only. So they might generally negotiate like this. Next 1 month, 1 year, you don't ask me. Now this question again came in your test your knowledge 3 also. Company taken one long-term loan from B in the month of December 2011. There has been a breach of a material provision of the arrangement. Now, as a consequence of which the loan becomes payable on 31st March 2012. So, breach has happened. Now, in the month of May, the company started negotiation not to demand the payment, and the financial statements were approved in the June. In the month of July, both the parties agreed that they will not be demanded immediately as a consequence of the breach. What is your opinion? Correct. Why? Because first of all, this agreement you didn't obtain within your financial statement approval. If the same was approved within 12 months, we can not to demand immediate payment, and the question is silent how many months? We can reasonably assume to be 12 months. But the problem is, even though it is 12 months, but it was done after this, now on 31st March, it is considered as a current. So you say that you can classify if the lender has agreed not to demand the payment as a consequence of which, if the lender agreed to provide a grace period of at least 12 months after the reporting period, it can rectify the breach, and during with that you cannot demand the immediate payment. So in the given case, they approved only after the reporting period, hence it will be classified as a current. Now again this question came in the exam. Now see, catch, no. There is a confusion, right? Breach, this, and one more question is there, that question is very silent. That's why where there is a confusion, repeatedly all the three questions have come. Now, entity obtained a long-term loan during 2019, which is subject to certain condition. The debt equity ratio should be 65:35. One of the condition, okay, in case the breach, the loan will be payable immediately. They also state that this condition will be assessed at the end of every quarter, repeated within a month from the end of the quarter. If the conditions are breached, the loan will be immediately. Entity closes 31st March. You are required to show how the loan will be classified on 31st March 2020. Okay, or taken in Jan 2019. When this is repayable, question is silent, so we will assume to be long-term loan. Now, at the end of the financial year, entity A determined it is not even breached any of the condition, whether current or non-current. At the end of the financial year, they decided they didn't breach any of the condition. Is it current or non-current? It's a non-current, very clear, correct? You didn't breach, no. How they can demand payment from you? Now, at the end of the quarter ended 31st December 2019, previous quarter, entity's A debt equity ratio is 75:25 and thus breaches the covenant. However, it obtains a waiver from the bank, and the terms of the waiver specify that if entity A rectifies the breach within a period of 12 months from the reporting date, then the bank cannot immediately demand the payment. This case, entity A expects to rectify the breach by raising additional equity money, and they think that their shares are going to get subscribed. 31st March, reporting, that's a confusion they created. What do you think? Yeah, very nice. Which reporting date? Quarter end reporting date or annual reporting date? Now, you need to make an assumption, it must be 31st March. Because it sounds like quarter wise, no, they are not asking here. So it is the 31st. If it is the 31st March, it is a non-current. Now, considering the same facts, except the waiver clause, what would be your answer if it was waiver clause was not there? Then it would have been correct. Easy question, right? But you see, 3 times, 5 marks. Yes, so you are going to say that the material breach of provision, you have to classify them as a non-current if they have agreed for not to demand the payment, or you are given a grace to rectify at least for 12 months so that you cannot demand. So in the first case, no breach only happened, so non-current. Second case, breach has happened and you have period a grace of 12 months to rectify, non-current. And here it is assumed to be, reporting period is assumed within the entity which can rectify the payment. Okay. In this case, there is a breach of condition on 31st March before the reporting date 31st March 2020, yet the bank has agreed to provide a grace period of 12 months. So it is assumed to be 31st March. In the last case, covenant of the branch has been breached and bank has to pay it immediately. So it is classified as a current. A has prepared the below draft balance sheet. Okay. Now they have got cash, cash equivalent, non-controlling interest, share of profit for the year, dividend declared, accounts receivable, inventory at fair value less cost to sell, complete and sell, investment property, and investment plant and property, plant and equipment. Now they have given you claim against the assets, long-term debt, interest accrued on long-term debt, share capital, retained earnings, profit, NCI, accumulated depreciation, provision, trade payable, accrued expenses, warranty, environmental restoration, which is going to expected in 2016, provision for accrued leave, and dividend payable. What you need to do is just prepare one consolidated balance sheet using current and non-current classification, assuming operating cycle itself to be 12 months. Now, what you need to do here? See, it's just it's a simple schedule 3 format. You have to prepare one balance sheet. But what you need to do? you have to reclassify into current and non-current items. And certain things like PP, they have shown gross block here, accumulated depreciation here. So you have to prepare notes to accounts where you have to tell this is the amount, this net. If you see provision for doubtful debts is shown here, and the debts are debtors paid, accounts receivables are shown at the top. So what you need to do here is you have to present it in the financial, and again this application classifying into current, non-current, you have to get, again you are going to get in analysis of the financial statement. One more chapter. Okay, this is actually very simple. There is no calculations involved here. You have to just do the classification. Okay, so how do you present this? What do you understand? What I should start with? If I have to prepare notes to accounts, what do I start with? Yeah, since there is no calculations required, it's just a doing. Like what I start with, if I have to prepare notes to account, just tell me which is my first note. Equity, will you start notes from the equity, or will you, what is the face of the PP? So you would have definitely started with the note number 1 PP. What would you have done? 5,200, 4,700, then minus accumulated depreciation. Followed, no? So you would have deducted from these two values, you would have deducted these two values, and net balance you would have written, which should be shown on the face of the P&L account or balance sheet. What is your note number 2? Is there any adjustments required? Is there any financial assets? Investment property is there, but is there any adjustment related to the investment property? No, whatever figures are shown here, you will show it on the face of the balance sheet. If there was an accumulated depreciation on investment property also, you would have prepared note number 2 investment property. If there was any goodwill, impairment of the goodwill, then you would have shown as a goodwill. So straight away I will go to the inventories. Inventories, there are two categories of inventories. One inventories which are shown at cost, and one inventory which I must have written off. Written off means it is cost is more than the fair value. But will you show it separately? No. You will give in notes to accounts, you will show it separately. But on the face of the P&L like balance sheet, you will show one item called inventory. So note number 2 will be inventory at cost plus inventory at a fair value, the total of these two. Are you clear? Note number 3, I will go to the trade receivable. I will minus the provision for bad debts. Now note number 4, I will go to the cash and cash equivalent. I will add both. Both are my current only. And note number 5, trade payables. Okay, NCA is on the show face of the thing. Dividend declared and not paid by A Limited is a financial liability. Then I don't have anything. Okay, here trade payables are there. Accrued expenses we are supposed to add to it. You remember Ind AS. It's a dividend declared and paid by A Limited. Okay, 1 minute. Who is A Limited? It must have already adjusted. We have to ignore it. It is not dividend declared and paid. 1 minute. Have they made any adjustment? Yeah, very nice question. Okay, this item should have come here. It's the payment portion. It's already paid, but it's not hit to your P&L. No, it will be shown in other equity, right? Negative, negative minus thing they have given it here. Otherwise, they should minus it from the other equity. No, that portion. Yeah. That's what. Nice. No, this question has come in your MTP also. 10 marks it may come. You should jump if you see this question. NCA will be on the face of the balance sheet, no other equity. In 110 we have discussed it. How to prepare, we have already done. Okay, now we are left with only one thing here. Okay, you have got a long term, what is that called? Cash and cash equivalent we have done. Other equity. In other equity we will have the retained earnings balance, profit for the year. Then we will show the, in the profit for the year, we are going to deduct the NCA share of profit, which they have given here, NCA share of profit. What they need to deduct here, they have shown it on the debit side. and the dividends paid. Followed, no? Like this, you are going to prepare. And here, let us talk about these items. What about your warranty provisions for 12 months from the date of sale? So 600 and you have got this becomes under current provisions, and environmental restoration provision becomes your non-current. Provision accrued leave within 6, this is also provision. Under provisions you will have 2 headings. Okay, so that's it. And this is dividend payable is a financial liability for you. Yes, so now how do we start? We start with the notes to accounts, PP, accrued depreciation, this is note number 1, inventory note number 2, trade receivable cash. In other equity, we will have the retained earnings plus profit minus NCI share and dividend paid. Long term debt. Now, in the long term debt, have they told you? It is 500 crores due on 1st of January. Have we done this? Some portion, we have seen, no, some installment, one installment is due. So, out of 3,300, we will deduct 500 and show only 2,800, and 500 will be shown as a current. You remember the 15 lakhs, 10 lakhs, 5 lakhs installment due and all. Trade payable accrued we are supposed to add by, who told us? Accrued expenses. Are you going to add to the trade payable? You remember in Ind AS 37, did we not discuss? Or students, in Ind AS 37, if you are ready to watch, we are going to discuss that trade payable is the one where invoice has been received. Accrual is the one where there is no dispute, only invoice is not received. If there is no question of invoicing only, then there is a provision. So, accrual is generally part of the trade payables. No? No, that's what. Accrued expenses is generally part of the trade payables. All your outstanding expenses. Because you know for someone to pay, but they only think they have not raised the invoice. But if you are not able to estimate, like you don't know who is going to come to you, warranty, that is a provision. So, provision is different from accrued expenses. This is what we discussed in Ind AS 37. Trade payable is a clear shot liability to you. Accrued expense is a liability to you, but there is no much uncertainty. Provision is the one which is totally uncertain. Therefore, you have got a separate head. Now, other financial liability will have your current portion of the debt, accrued interest and the dividend paid. With this, you will prepare the consolidated balance sheet. You say PP, investment property, no note because it is straightforward figure. Inventory, there is a note. Financial asset, you have got note number 3 for trade receivables and cash. Equity share capital, no note because that is straightforward. Other equity, there is a note required. NCI, you have got 830 and 540, which is this, and where they have already added that balance. 840 and let us see, 830 and 540. Sorry? Yeah, this is dividend declared and not yet paid. Maybe this is an interim dividend. This is the final dividend of last year or somewhere, or it can be, see, this dividend can be kept with you for 7 years, no? Is it necessary that this year's dividend only it is? You have got 7 years to pay, you have to keep it in a separate dividend payable account. So, maybe that is that dividend. So, last one, when it comes to non-financial liability, long-term borrowing, except that one installment. This year's, not dividend payable, this is a P&L item actually. What we adjusted here, no, dividend paid, this is current year provision. What accounting entry we must have passed for this? Dividend expense account debit to bank. Then what entry we passed for the dividend expense account? Retained earnings account debit to dividend earning. Followed, no? No, we have paid this. Okay. But they said paid, no. So that means this must be, what I assume that this must be interim dividend. If they, since this categorically said dividend paid during the year, declared and paid. That is possible only for interim dividend. No, final dividend is impossible that you declare and pay. So what I assume that this must be interim dividend. And what dividend payable is shown here? It must be that 4 year back, 5 year back, non-traceable people's dividend is there. No, that is this dividend. This dividend will come in my next year opening balance. Interim, that sounds like an interim dividend. Otherwise, if they would not have told me dividend declared by A Limited, is there actually notes to accounts? Is the reversal of provision there? Because now question comes, which dividend declared? If it is the final dividend declared, then I have to reverse it. If it is the interim dividend declared, then I have to assume that it must be sitting in this payable. I may adjust it here. Are you clear now? Okay, so last is the provisions for the long-term provisions, that decommissioning liability. Financial liability, trade payables other than MSME, we will give the note where accrued is added. Other financial liabilities also we know now, dividend payable and other things. Provisions, we have got two, warranty provisions separately on the face, other short-term provisions which is not on the face. That's why we didn't add any note number 9 and we didn't add both. Why? Because out of two warranty provision, I should show it on the face of the P&L balance sheet. Easy question. Purely on current and non-current. Yeah, they may ask you for 6 marks, not worth 10 marks actually. No calculation, no, what is there actually? 5 marks they should ask. Format, any of this format is already part of your all big questions. Yes, students. So last we will move on to the third balance sheet, presentation of the third balance sheet. Now, as per Ind AS 1, entity shall present a third balance sheet only if the accounting policies are retrospectively changed or makes a retrospective restatement of the items in the financial statement. Okay, in Ind AS 8 we are going to come across the accounting policy change, retrospective change last year which may affect the opening balance. Reclassify the item in the financial statements, and such restatement or reclassification has got a material effect on the information in the balance sheet at the beginning of the preceding period. Then you have to give. If any reclassification you do, retrospective restatement you do, restatement of the last year, but if it's affecting the opening balances, you have to do the present the third balance sheet. Now, under what circumstances entity is required to present the third balance sheet? I don't think so they will ask you this. It's a theoretical question. You have to apply the accounting policy retrospectively or make a restatement or reclassifications. Restatement means you reclassify it, recalculate it. Reclassify means you just shift the head from one place to another. You remember this like finance cost and operating cost. It is a reclassification. Restatement means you recalculate some amount. Depreciation is short calculated. Now, if such things has got a opening material effect on the opening period, yes, you are going to present the third balance sheet. Now, what type of examination questions you may face? A company presents the financial result for 3 years, 1 for the current year and 2 for the comparative period. Can they give for 2 comparative period? Yes, this is what Ind AS 1 we discussed first. What is the minimum comparative? 2 for balance sheet, 2 for P&L, 2 for cash flow, 2 like wherever required, notes to accounts also. If the company wants to present something extra, can they do? Yes. So what they have done, 1 for the current and 2 comparative periods they have given. So totally 3 years they have given. For the purpose of, internally, they are doing it internally for the purpose of management information every year, in addition to the general purpose statements. The aforesaid financial results are presented without furnishing the related notes because they are not required by the management for internal purpose. So what management wanted internally, they wanted to look into this current year and 2 years comparative, not just last year comparative. So what the management did, not same thing they had presented, but they didn't give the notes to accounts because management is not interested in the notes. Last year, though, definitely mandatory, but before that last year. During the current year, management thought, why not they should present a third statement of P&L account. Also in the general purpose financial statement. That means till now what they were doing, management was analyzing general purpose financial statement along with current year and 2 years. But for the shareholders, what they used to give? What is required by the law. Now this time they thought, why not? They should present the third year statement of P&L in general purpose financial statements also. It will save time and will be available easily whenever management needs in the future. With reference to the background, can the management present third statement of P&L account as an additional comparative in the general purpose financial statement? Yes, answer is yes. If the management present the third financial statement, is it necessary that it should be compliant with Ind AS? Obviously. Can the management present third P&L only as an additional comparative in general statement without furnishing other components? Balance sheet and all I will not give, only P&L I will give for comparative. That is possible. It is not that when you give that additional comparative, it is not mandatory that you all the comparative you have to give. Minimum 2 sets you have to give, which is required by the law. But if you want to give only third year balance sheet or fourth year balance sheet, only give that. You do not give the P&L because that is a choice, additional thing. 2, you don't have a choice. Notes wherever relevant it is. Yes, in the management may present the comparative in addition to the minimum. Question is, more than minimum can I present? Yes. But it should be prepared as per Ind AS only. I may present something in addition to the minimum, and this comparative may be only one or more statement, need not be complete set. Only balance sheet, only P&L I can present. Okay, next question. Yeah, probably the last question. The company, while preparing the financial statement, in fact, the previous question, no, this question should have been under the first category, general purpose financial statements. So I think I had placed it here under the third balance sheet. It has nothing to do with the third balance sheet. The only question on the third balance sheet is this, which is your test your knowledge 7. Company is preparing the financial statement and erroneously booked excess revenue of 10 crore in the year 11-12. The total revenue for the 11-12 is 80 crore. However, while preparing the financial statement for 12-13, it discovered that the excess revenue was booked in the year 11-12, which is now want to correct in this current financial statement. However, the management is not sure whether they need to present the third balance sheet or not as an additional comparative. Okay, it is more like a rectification of an error. Last year error happened. Again, we can actually shift this question also. This question we can shift back to, even though they have given you in your this chapter only, we can shift to Ind AS 8. All these questions will come there. Something having problem, something not having, like classification had an effect with the opening balance. Finance cost into this classification didn't have any effect. Now, is it necessary to present the third balance sheet at the beginning? And the company wants to correct the error in the 12 by giving the impact of the figures of the current year only. Can they do it? No. They have to change it. It's a pay-period item. So you say that if the pay-period third balance sheet will be presented only if it is retrospectively restated, restatement happens or reclassification happens. Such classification has got a material effect on the opening balance. In the given case, last year revenue was problem which required to be rectified last year only. So I need to pass one accounting entry last year hitting my P&L account. Now this results into retrospective restatement of the financials. However, that does not affect any of the opening balances. Now if the revenue was wrong, my accounting entry is P&L account debit to revenue. So hence the third balance sheet is not required to be presented. Or maybe my accounting entry is debtors, revenue to debtors, because revenue is overstated means debtor also must have been overstated, but it has nothing to do with the opening balance of the debtors. The debtors came right now. So now the contention is not correct. Management need to correct the previous year figure as a pre-period error. They need not furnish the third balance sheet at the beginning of the third. Are you clear, students? Yeah, probably what I can do later, I may shift this particular portion into Ind AS 2 only, because all the problems together, no, gives you better understanding. Yes, not Ind AS 2, Ind AS 8. Okay, students. So with this, we are done with this particular standard. We are completed.